Let's take a look at this women in tech jobs community making $257,000 per year in profit and recently listed for sale at an asking price of $828,900. That is a 3.2x profit multiple. We'll start off here by talking about this number, or at least addressing it, the annual growth rate of negative 47%. This just seems so much like a curveball, as you're going to see in the context of the rest of this listing, which really has a lot of positive attributes. Okay, so we'll talk about, or let's just kind of get into what the business actually is. It's described as the largest women in tech jobs community with 150,000 members, 78% EBITDA margins, $302,000 a year in annual recurring revenue. Founded in 2015 as a grassroots series of coffee meetups, it quickly grew into the largest global network for women in technology. It was acquired in 2021, so that means this business is not owned by the founder, and it evolved from a passion-driven community into a diversified, high-margin platform with multiple streams of revenue. And for the low, and I say that sarcastically, low price of $828,000, you get the rare opportunity to acquire this profitable category-defining brand. The valuation reflects a business with strong recurring revenue, a deeply loyal community, best-in-class margins, and multiple avenues of meaningful growth. Let's see what else we can pick out. Customer base of 1,000 to 5,000. $302,000 a year of annual recurring revenue, as we already know. Annual growth rate, negative 47%. And under the business model, they say hiring partnerships. So this is, how the business actually makes money. Hiring partnerships, B2B subscription, membership, B2C subscription, events and newsletters. And we've got a series of growth opportunities here, including increased digital marketing, social media marketing, expanding to markets, higher sales team, improved conversion rates. All pretty generic stuff. I don't see anything too specific. Key assets. I think it's important to call out a job board and a candidate database. So my understanding here is, first of all, that they've probably got some free community based on the 150,000 members, but only 1,000 to 5,000 customers. And it is fundamentally like some type of job board, or that is what's monetized, considering membership, B2C subscription, and hiring partnerships. That's the first thing they stated as B2B subscription. So possibly companies sponsor this job board or pay to get access to the database, something like that. I really like the business model. Fundamentally, it is a community model, and typically, once you get a community going, it's very hard to start, but once you get it going, it is very robust and sustainable. The community builds itself. I also really like that it's not founder-led, because oftentimes in these cases, the founder kind of builds the community around their personal brand, and it's very hard for them to step aside. In this case, it was acquired in 2021, so it's operated now for 4 years or more. I'm recording this on November 6, 2025. Without the founder, or under second ownership, or under acquisition, I guess we could say, post-acquisition. So it's done quite well. It's got 78% margins, $302,000 a year of annual recurring revenue. There is a lot to like about it, but we've got this curveball of negative 47% annual growth. And that is not just little, that is like a freaking nosedive off a cliff in annual growth. And I initially thought, okay, well, maybe that number is wrong, right? Maybe this is a typo in some way. So I went to another listing by this firm here, acquire.com. If you're looking to acquire an online business, no doubt you're going to run across acquire.com quite a bit. And on that note, if you are looking to acquire an established and profitable online business, let me plug my newsletter here, Acumen Wire newsletter. It's a newsletter I run where I send out online businesses that were recently listed for sale, along with my quick take in a focus on established and profitable online businesses. I'll put a link somewhere around the video so you can head on over there and get signed up to my free newsletter. We'll come back now and come back to the program and talk about where I was going with things. That was acquire.com. I looked at some of their other listings. They typically publish these as positive when the businesses are growing, but we can also see some further context down here with the last month's revenue and profit here. Number one, the margin is a lot lower than 78%, but if we were to multiply this out by 12 to annualize it, it would be about 50% less than the profit that they're stating. So the business is in substantial decline, and that really impacts how we should value a business. Okay, so let's just kind of talk about that a bit, because I think this really gets overlooked, and that is the fact that a business should be valued on its future stream of income. So we typically look at the multiple based on the last 12 months, but realistically, from a financial investment perspective, we need to consider the future stream of income that that business will generate, or the future opportunity, if we're being a little speculative, that this business has. So right here, this business has been valued at 3.2x on the last, what I'm going to assume is 12-month profitability, because we know it's certainly not the most recent month or 3-month based on the limited or based on the low profit relative to what they describe here. So I'm going to assume that this is based on a 12-month profitability, or based on the last 12 months of profitability, right? 3.2x. But what would things look like going forward? And before I say that, let's just kind of talk about the business valuation on 3.2x in the business model here. Based on everything I'm seeing in the details and what this business model is, I think if this business were stable or growing, a 4x valuation on the last 12 months would be realistic. Maybe even on the next 12 months, if it's stable and growing, right? If it's looking at the last 12 months, we're kind of assuming that it is going to do the same going forward. And I think that if this business were healthy and stable, 4x on the next 12 months would be good. But it's not. It is declining, right? So we have to consider what the actual profitability is going to be. And if we look at this 257,000 and assume that over the next 12 months, it's going to continue this trend of declining at 47%, next 12 months profit to the buyer is 161,000. We really need to be assigning a valuation multiple to this. And if it were stable, and I'd say we're worth 4x or likely to trade at a 4x multiple, that would be a totally different number. It's not. It's declining. So I really think that the valuation multiple in this case, when it's in a decline, needs to be assigned to this. And if we were to say, well, okay, we'll just pay a 4x on it for the business model itself, that's $647,000. Which is less than the 3.2x multiple on the prior 12 months. See what's going on there? The valuation multiple considering the future earnings still doesn't line up. You might look at this and say, okay, well, Corey, you're saying that it would trade at a 4x multiple if things were stable, but it's declining, so we're going to give it a little less multiple. We're going to adjust the valuation multiple for that to 3.2x, but still going forward, valuing it at 4x for the business model based on the projected future income, future annual income for the next year, it is still lower at that 4x valuation. I think this really highlights just a major kind of demented view that people can take when they're looking at valuation multiples, considering that they're based on prior time periods and not what things are going to be based on going forward, and how they should be adjusted for. Because I have no doubt that the seller of this business would say, well, that has already been, the decline has already been factored into the price. However, when you look at it relative to the business model in the future earnings, as you can see here and as I just did, I don't think that the adjustment to the valuation multiple is really reflective of what this business is going to trade at in the market. What's your take on that? Let me know in the comments. Do you agree with me that looking at the business model, basic business model, and assigning a valuation multiple to that, and then looking at the forward earnings is realistic, or just adjusting the multiple in the last 12 months, considering it's in a decline, is going forward? Now, ultimately, everything is kind of a rule of thumb, right? It really depends on the buyer and the market conditions for what the business would trade at. That said, currently speaking, I really don't see this trading at even $647,000 because the business is in such a substantial decline that as a buyer, you got to consider the risk of catching that falling knife. So while I do say that in a healthy scenario, the business model may be worth 4x, I think that in the substantial decline that it's in right now, it's not worth 4x of even the future cash flow. I think that, oh gosh, it's really hard to unpack because we'd really have to unpack why is this business declining so much in revenue and subsequently profit. Where's the user base going? I really don't know what it could be. Is there another competitor that's popping up and stealing these? Is it just poor management of the community? Did the founder actually leave? Maybe the founder was tied into the business at acquisition in 2021 and they're like, hey, you got to work with us for a few years here and we'll, have some type of earn-out structure or performance-based compensation structure for you. And the term was up at 3 years. The seller or the founder left. And suddenly, since the founder left, they're in substantial decline. Or maybe their non-compete expired and they spun up something to compete. To really value this accurately, we would need to know what the catalyst is behind this substantial revenue growth. Maybe it's, or decline in revenue growth. Maybe it's Google, SEO type of thing. I'm really not sure. We don't have enough detail in this listing to really unpack it. What do you think? What do you think could be the catalyst for substantial revenue decline in the largest women in tech jobs community? Let me know in the comments below and let me know what your thoughts on the valuation are. I'd love to hear from you guys. On that note, I am calling it a wrap and signing off on this one.